Well, we've just seen today figures released from the May FNB House Price Index, the index rising year on year by 11.9%, reflecting further improvement on the previous 10.1% inflation rate. Joining us now to provide some detail is John Loos, who's property strategist at FNB Home Loans. Thanks so much, John, for joining us.
Alicia.
Well, looking at the acceleration we've seen, one would assume that to a large extent this comes as a result of the 5.5 percentage points worth of interest rates cuts we've seen thus far, and the effects that have started to finally filter through.
That's right. Well, I wouldn't say finally filter through. They've been filtering through for quite some time now, Alicia. But yes, I think the dominant driver has been the big interest rate cutting that we've had to date. And a minor partner in that has been the recovery in economic growth, which should have by now brought real disposable income growth back into positive territory, and that also just helps the purchasing power of the consumer as well. But I say that's the minor partner. It's a credit-driven market to a large extent, and so interest rate cutting, I think, is the big one.
Well, of course, on a year-on-year basis, the increase is pretty slight. In real terms, adjusted for consumer price inflation, what kind of growth have we seen on a month-on-month basis?
Month on month is running about 0.6 now, I think, if I remember the number correctly. But month on month is not so important because there is a seasonal factor in there. So I like to just focus on the year-on-year numbers.
So looking at those year-on-year figures, then, if we look at this, with a holistic view, to what extent does this mark the comeback of house prices in 2010?
Well, I'm not sure if I'm understanding you correctly, but it's
just in terms of, getting back recovery to where we were, before the crisis.
Yeah,
is this a comeback?
It's pretty much done away. The 11.9% year-on-year increase is more or less done away with all the deflation that we had during that deflationary period. And to take a broader view, if one looks over the past almost 10 years, our data starts in July 2000, so it's almost 10 years ago to the month. We've had 200.4% cumulative increase, which obviously you've got to adjust for inflation. That's about 68% in real terms cumulative. So the deflationary period that we had up until late last year couldn't nearly wipe out the gains that we had during the property boom over the past decade.
Well, if we look at it, this, of course, an average house price index that we're looking at. Is there a distinction to be made, though, between the kind of homes seeing this uptick and enjoying somewhat of a lift that we're seeing here?
Well, at the moment, it's very difficult to determine any winners. There was a stage of the property boom where, for instance, you'd have got in the early stages of the property boom, the sort of more luxury segment was outperforming the lower end. Then there was a latter part of the boom where the affordable segment was booming and the others were slowing down. At the moment now, it's a very broad recovery. I'd say the more affordable side of the market just lags a little bit, but they're all turning up, they're all recovering, the volumes are picking up, and there's not much to choose between them. If one looks at regions, however, we do get some weak points still. We calculated an Eastern Cape house price index last week, and that was in deflation still. I think the two areas that were very hard hit by the recession, and especially by the manufacturing recession, were those manufacturing dependent economies around Mandela Bay, the Eastern Cape and KwaZulu-Natal with its big manufacturing base. They were harder hit during that recession. I think they're struggling. They're taking a bit longer to recover than, for instance, the more services driven and therefore more stable economies of Gauteng and the Western Cape.
Well, those are just some of the categories that we have to draw distinctions between. Your report also highlights that when we look at these figures, while the lower inflation rates have spelt, very broadly speaking, good news, because along with economic growth, it spells positives from an interest rate point of view. If we look at the reflection this spells for the rental market, it isn't entirely good news.
No, we saw the CPI coming out last week, and there's a rental component to it, and very low inflation rate. They're below 5% average for the market for the rental market as a whole. Now, what we need for the buy-to-let component of the market to recover, and that does lag. I think the recovery has been overwhelmingly primary residential demand driven. For the buy-to-let market to come to the party and drive the recovery, you need wider yields. And at the moment, it looks like house price inflation is faster than rental inflation, which means that we're making no progress in widening the yields and making buy-to-let property more attractive. So I think we must be realistic about how much we can expect expect from the buy-to-let market during this recovery.
So in that context where we've got PPI levels for now supportive of residential developers and contractors as well who've been struggling to build in a competitively priced or bring in competitively priced stock to the market, what demand are they actually catering to right now?
Well, at the moment, I think that probably most of your developments, the development sector has seen a big drop in numbers. To give you an idea, square meterage of building completions in residential space dropped by 42% year on year in the first quarter. So it's a very, very weak situation still in the development part of the residential market. I think the sector that's been hardest hit in that downturn is the so-called flats and townhouses, where I think there was a bit of an oversupply created. And probably the one that's doing the least badly at the moment, or the best out of the deal, is probably the affordable housing segment. So freehold affordable houses, and there still seems to be significant development, but higher up the ladder and in the bigger sized houses also very weak.
What's your outlook then, John, moving forward? Because like we've been saying, we've got inflation sitting back within the target band. We've got interest rates being held stable, being held at relatively low levels, and economic growth prospering as well. What's your outlook moving forward?
Alicia, I think for the rest of the year we will have price inflation, but I think in the second half of the year we're going to, just after mid-year, we'll probably see the peak in price inflation. It might get to somewhere near to 15% and then starting to taper off, slower year-on-year growth. The reasoning being, firstly, I think there are signs that the global economic growth recovery is reaching its peak. G7 leading indicator, growth rate starting to decline. We've just heard about the manufacturing PMI, so I think that's our growth peak coming too. And then there's also a lack of interest rate cutting from here onwards, so a lack of further stimulus. And in the second half of the year, that positive impact from last year's big interest rate cuts will slowly start working its way out, or will come to completion. And then with a lack of further rate cutting, we anticipate that year-on-year house price inflation will start to slow down.